Adam Cmejla, welcome back to the podcast.
Thank you, Steve. Appreciate you and appreciate you having me back on the show.
Hey, we were just talking before, and I referenced a LinkedIn post that you put up. And I'm starting to see a theme here, Adam, that one of us will post something on LinkedIn and it triggers a podcast episode. It's not the first time this has happened, but I'll be I'll kill the suspension here. We're going to get into taxes. We're moving into tax season, but you had posted something, and I'm just going to read it here. You shared a story about a tax return where a CPA claimed an $83,000 qualified business income deduction that the doctor likely did not qualify for.
Yep.
Oops.
Yeah.
Oops.
Yeah. Those are not the
So
fun ones. I like the other ones where we find a deduction that wasn't claimed or that we can add to this because we've seen those as well where they qualify for 199A and it doesn't get elected or the CPA completely missed it. All respect to the CPAs that might listen to this. Those are the fun ones when we get to have those conversations on claiming deductions. But yeah, this one, unfortunately, not so much.
Well, you don't want to be the bearer of bad news. So let's get into that in a minute because I want to ask you how I think doctors have to face somewhat of an ethical dilemma sometimes. Really, anyone does that could potentially get that news. And looking at it, I'm curious your thoughts. I mean, be careful how I word this because we're not obviously suggesting anything unethical. But if somebody were to look at that and say, "What if I don't get caught?" So let's come back to that one, if
Okay.
that's all right. So feel free to elaborate on that if you want. I mean, obviously that's a mistake that wasn't caught, but elaborate on that or just more in general from the work you do with practice owners and professionals. Can you speak to some of the most common tax mistakes you made? That was one of what are some of the most common ones that you see?
Yeah, so that one is one of the more common ones that we see, and we see variations of the error on that. And as a firm that has been entrenched in so many practices, their financials, inevitably the business returns, the personal tax returns, et cetera, we kind of joke like inside our organization, we know where the bodies are buried. Like we know the usual suspects and what pages to thumb through on the tax return, what forms to look at to make sure that all the proverbial I's are dotted and T's are crossed. This specific example, so the non-technical abridged version for ODs listening that may not be familiar, there is a piece of tax legislation that was put into effect back in 2018 as a result of President Trump during his first term, the Tax Cuts and Jobs Act. Basically, there is a deduction out there called the 199A deduction, and if you qualify, and the way in which ODs qualify is your income has to be below a certain threshold or you have to have business income that is what is not called an SSTB business or SSTBI, specified service trade business income. Again, dancing the fine line here without going down the deep technical rabbit hole, the vast majority of ODs listening right now qualify for the QBI deduction, qualify for the 199A. Whenever you hear QBI or 199A, those are synonymous. They're the same thing. The vast majority of ODs will qualify up until a certain income amount on their personal return. Once that income goes over a threshold, do not pass go, do not collect the 199A deduction, which is a 20% deduction on your personal return, a 20% deduction on qualified business income. So in this example, the client had adjusted gross income of over $1 million, which is well above the threshold in which someone is either able to or not claim the 199A deduction. How this error happens on most returns that we find is there is a box that a tax preparer will check when they are filling in all when they're plugging the holes, if you will, on their tax prep software. So CPAs behind the scenes will be plugging in this information, bringing it in from QuickBooks or whichever other accounting system that they're using. And there is usually a box that gets checked that says, is this or is this not specified service trade business income? If it is, now we're back to those income thresholds of whether or not the doctor is eligible to claim that deduction. If it's not SSTB income, Now somebody could have $5 million of income or $10 million of income, whatever that is. There's no income threshold. There's some additional calculations that go into actually calculating the 199A deduction. And that's what happened in this situation. The CPA just, whether they forgot to or didn't connect the dots, that again, all love and respect to our CPA friends that listen. The tax code has consistently got more and more and more and more complicated. More pages are added, more amendments are added. And yet we haven't pushed back the April 15th deadline, March 15th for business returns, right? So CPAs and their clients from basically the beginning part of February until March 15th, assuming that they are not trying to extend their filing deadline, have to get out 1099 letters. They need to finish W-2s. They need to get all their financials in order. Like, it is almost an unfair request to ask that CPAs and clients get that type of volume in by March 15th. So again, all love and respect to our CPA friends and accounting friends that might listen to this conversation. We get it, we understand it, which is why we as our organization want to be a second set of eyes on those returns. The 199A is one of those areas in which you just got to be careful with it, because the claiming of it when you don't qualify for it, maybe I'll bring back the question that you seeded earlier when we hit record is, well, now what? How do we address this going forward? And maybe I'll put a pin in that again, and we'll come back to it towards the end. Let me address some of the other areas of returns, or maybe not other areas of returns, but just if I can shift the conversation slightly, Steve, it would be, what are some of the, as this is the time of year when everybody is thinking about taxes, one of the phrases that we will talk about is nobody likes paying taxes, but the thing that people like exponentially less than paying taxes is being surprised by taxes. And so in this season, in the spring here, when people are thinking about taxes, we can use what has happened in the over the past year as a precursor or as a preamble to what can we do going forward that can help us either not be surprised by taxes, not pay penalties and underpayment penalties specifically when we otherwise might be paying them now, and what other strategies to consider. So which direction would you want to go? Would you want to go? Do you want to talk a little bit more about the ethical dilemma in this situation, or should we unpack some of the other strategies and areas to look at on the return, given that people are going to be focused on that this time of year?
Let's go back to the ethical thing because here's where you mentioned something that I it caught my attention, the second set of eyes, because I think a
Mm-hmm.
lot of people file their taxes, they get it back. They just assume it's
Yeah.
done right. They assume it's accurate. A CPA signed off on it. But I always notice that note on my own taxes. It says to look it over and basically check and make sure everything's accurate. Well, if you didn't get it right, I'm not a CPA, right?
I was like,
I mean, I don't know if the IRS is looking. I don't know if I'm supposed to, but I don't know enough about that to look that over. And unless it was some glaring inefficiency, I actually glance it over to make sure that
hmm
what I can assess anyway is correct. But I think from a lot of businesses, they don't have that second set of eyes. That's kind of what you do, right? So a client of yours would have that. But what happens then if we take that tax return, assume it's done correct, and we file it? Is there the possibility then years later that could come back to haunt you?
The short answer is yes. In situations like this, I've never worked at the IRS. I don't know anybody that works at the IRS. I don't exactly know how the sausage is made behind the scenes there, but pragmatically speaking, from my point of view, if the IRS was wanting to go fishing for returns that were done either incorrectly or where excessive deductions were taken knowingly or unknowingly, it would be a simple, okay, I'm the IRS. Let me plug in NAIC code, which is the code, the 5-digit code that when you look at page 2 of your return, it says optometrist under profession. There's an NAIC code established with that. I can't remember what NAIC stands for, but basically it's the government's way of numerically tracking the different professions. So I could run a report as the IRS, show me all optometry returns, of which an adjusted gross income of greater than the phase out limit and this specific 199A deduction was claimed. Enter, here's my report. Now I have a list that I can scrub to see, did people actually take the deduction and they didn't qualify? Or were they, oh, this person, yes, they're above that threshold, but because they have a restaurant business, which is not an SSTB business, back to what I mentioned earlier, they actually do qualify for it. So again, it would give them the raw data sample set to start working through, which from my perspective, that's where it just comes down to the ethical dilemma of does the OD want to amend that return or not? Now, let me share how we address situations like this. Number one, we are never wanting to be in the position of making somebody look bad. And so, what we will always do in situations like this is go to the CPA first behind the scenes and make sure that we say, hey, look, just as a second set of eyes, we know you have a lot going on during tax season because all we do with work is work with ODs. We know where to look on returns to make sure that we can help you help the client. We noticed that this deduction was claimed even though their income was above this amount, and on the 199A document in the return, this box was not checked. I just wanted to bring this to your attention and let them decide how they want to proceed. I'm putting them back in the driver's seat of how they want to navigate the situation with their client. The last thing that we want to do is go, hey, Mr. Client, guess what your CPA did? They messed, like, we are not in that business. Nobody comes out looking good in that situation. And so we will always do everything that we can behind the scenes. In some certain, I'm not going to name names. We have some CPAs that we've worked with, none in the optometry space, but we have a handful of clients where their CPA, how shall we say, is aggressive. And they think that because there is part of optometry that is technically, if it was a standalone business, it would not be considered an SSTB, a specified service trade business. If it was just a retail business, which is what the CPA will think, oh, well, the client made $2 million dollars, or the gross revenue of the practice was $2 million, dollars, of which 1.2 million was attributed to optical sales. Optical sales is a retail business, ergo 1.2 million of the $2 million dollars in revenue can now be considered, and the income generated off of that 1.2 in revenue, that can qualify as an SSTB. And look, we're not CPAs. We don't generate the return, but the IRS or the IRC, the Internal Revenue Code, is pretty clear that you cannot split the business like that because they are essentially related businesses. That issue aside, those are the only asterisks, if you will, where there can sometimes be friction behind the scenes of our opinion as our professional opinion versus their professional opinion. Now, mind you, our name is not on the tax return. So at the end of the day, if the CPA is going to essentially hook their wagon to that return and take that stance alongside the client, that's their decision. That's their professional opinion. Most of the time, though, when we bring this to the attention of the CPA, they will work with the client and all is well in the world again. If it comes down to the, and now one thing that I want to just reframe in this conversation, because and kudos to one of the lead advisors in our firm, John, who did a really good job of kind of repackaging this and thinking about this, because OD is listening right now. Now, in this situation, the client, you mentioned the numbers at the beginning, the deduction was like an $83,000 deduction, while their income is over $1 million. So that is basically a 37% tax rate that they're going to pay, assuming we amend the return, that they're going to now pay, and translates into about a $30,000 tax bill. To which John had a good way of rephrasing this. It's like, well, they always had legally a $30,000 tax bill. It's just when are they paying it and how are they paying it? So it's not like, oh, I've got to pay an extra 30,000. It's like, no, you always legally, ethically, morally did have that number to pay. It's just a matter of how it eventually reconciled out.
Right. And like you said, nobody wants to be surprised
Correct.
by a tax
Correct.
bill.
Yeah.
If it's a, because I'll bet there's people wondering this, if it's a mistake that we could trace back to the CPA and it's later caught, let's say under audit, does the accountability fall completely to the client in that case? And are we talking about fines attached to this, or is it just you messed up your taxes, here's what you owe us that you didn't pay before, or
There
are
will
we talking
likely
about
be,
fines and
yeah.
penalties?
Yeah, good point. There will likely be interest and penalties on that because you technically underpaid your tax bill. Now, you're waving the white flag. You're proactively amending a return. The IRS, again, I'm not an enforcement agent. I'm not. I'm saying this based off of good faith estimates, right? I would be hard pressed to say that they're going to take it even further and say, "Oh, well, you did this, so now let's launch an audit into previous year's returns." Could they? Yeah. Have I ever seen that happen in the work that we've done as advisors, not as CPAs, but as advisors? No, I've never seen that happen. And we've seen, like, this is not the first oversight or mistake that we've seen on a return. So it's one of those, it's a good faith effort correction, wipe your hands of it. In a worst case scenario, typically the client will bear the full brunt of any underpayment and penalties associated with that. The CPA could potentially be involved if it got as far as an audit point of view, but admittedly, that is even outside my area of expertise, and I want to be careful on opining as to what it would mean for a CPA as it relates to their relationship with the AICPA, which is essentially their governing body and membership organization.
Adam,
Now,
I've heard, oh, I'm sorry, go ahead.
now one more thing, if because we've spent and err on my end, I apologize for going down this deep rabbit hole on the 199A. If ODs listening are wondering whether or not they are coloring inside the lines of this, easy way to go look is check on your tax return, look at Form 8995A. That is the form that documents any and all qualified business income that any of your businesses, again, you have to be a practice owner. You have to have this type of income. If you're an associate in a practice receiving W-2 wages, do not worry about this conversation. Still listen to the I Own a Business podcast, but this specific conversation is not going to be relevant to your situation. Go look at that 8995A. There's a box that you can see up at the top, maybe top quarter of the form. If it's checked, you're in good. You're all good. If it's not, best thing I can say, have a follow-up conversation with your CPA.
So I've heard you distinguish before between tax planning and preparation. So I think most of what we're talking about so far has been tax preparation, somebody else preparing your taxes. You work with clients on tax planning.
Correct.
Okay.
Correct.
Can you define the difference and maybe give us an example of tax planning? And would that potentially put you in a better position where you're filing a clean tax return without some of these mistakes that we're talking about?
Yes, the easiest metaphor that I've thought about or that I've come up with is tax preparation is looking through the rearview mirror, tax planning is looking through the windshield. And so both of them are related, right? If I'm driving a car, I'm transitioning back and forth. If I'm back in, I think you're using both of those. So it doesn't make one better than the other. It doesn't make one absolute and the other non-existent. They're both complementary to each other. The tax and what I mean by that is we can use the information that we received from the tax prep process. So when I look at my return and what I am having to owe or what I'm getting back as a refund, your tax return, just as you've probably heard me talk about the financials in your practice, your tax return tells the story of decisions that you made at some point in the past and the manifestation of those decisions from a financial point of view on your tax return, which is essentially the final score that you're sending to the IRS based off of all the activities that happen in your business. That's why slight digression or a little bit of a right turn when we talk about the transitions of practices and we look at doing statements of value on practices to transition a business from one owner to the other. At the end of the day, the most important documents for us are going to be able to see are wanting to see your tax returns because we can massage numbers in a lot of different areas and we can make things look better and look worse. But at the end of the day, what you reported to the government in the form of your personal and professional tax returns, that's really the only normalizing factor that we have when it comes to actually understanding what type of cash flow did this business generate and how much did the owner benefit from it. So, that being said, we can take the return and using that return and saying, this is how much money the business made. These are the expenses associated with the business. This is how much net income the business produced for me as the owner. This is how much I paid myself as a W-2 employee. Or if you're in a partnership in guaranteed distribution or guaranteed draws off the practice. However, you as an owner benefited from that business, we can use that information based off of last year's numbers to better inform us on what to expect this year. One of the simplest ways that we like to talk to practice owners about not being surprised by taxes is to do what's called penalty proofing your return. Penalty proofing means if your income is over, I believe it's 100 and I don't know if we got a wage adjustment this year or not. I think it's if If your adjusted gross income is over $150,000, you essentially have to pay 110% of whatever last year's tax liability is, or 90% of what your current year's tax liability is by April 15th, by April 15th, without, if you do that, you will not incur any type of underpayment penalties. Underpayment penalties is the most free money that we see business owners give and practice owners give to the government. All it simply means and all it tells us is that we didn't do a good job or the client didn't do a very good job of proactively managing the cash flow in the business and how they decided to share, whether you like it or not, what you legally were obligated to pay the IRS. And so penalty proofing your return and working with your advisory team to understand what that number is and how you satisfy that number throughout the course of the year is the best way to understand what your projected tax liability is going to be. You may not like it, but it is what it's going to be. And then how to not be surprised come the following April 15th when you have to pay. Let me, just because I said the word April, or I said the date April 15th, and it's been a hot minute since I've said it, let me state one of the other biggest misconceptions that we will hear from ODs. Because everybody that gets scared from a tax standpoint will say, oh my gosh, my CPA told me how much I owe in taxes. Let me just file an extension and buy myself some time. Practice owners listening right now, anybody listening right now, please understand that an extension to file is not an extension to pay. Even though you may file an extension and not file your personal return until the deadline of October 15th, which is the absolute deadline, your deadline to pay the tax that you owe is still April 15th, assuming it's April 15th of whatever tax year we're filing for. After April 15th, if you haven't paid what you've owed, penalties and interest are going to start accruing. And in today's interest rate environment, that can stack up fairly, I don't want to say fairly quick, but depending on how much you owe, it can add up to a number that none of us like to pay. So I just want to make sure people understand that an extension to file is not an extension to pay. That's my public service announcement for this conversation.
Um, you mentioned before the term aggressive, and I've heard CPAs classified. I think everybody's wondering, do I have a good CPA? Where do I find a good CPA? And I've heard the terms both aggressive and overly conservative
Mm-hmm.
used. In your experience, understanding you're not a CPA, but working with them, can you give some how would you qualify each one if you were going to say, without calling out anyone in particular, but as you've worked with different CPAs, where would you say that this one's a little aggressive, almost to the point where it makes me a little bit nervous, versus overly conservative, where a CPA is not maximizing the return for the client?
I actually have a couple of examples, and I may not make some friends in saying this just because I'm sure there are listeners that are doing this right now, but let me just give you some examples. Again, one person's opinion, take it for what you paid for, which was nothing because you subscribed to this podcast, right? You clicked on us. You're listening. That's a subtle shot there, but I hope it makes sense. My point with this is I think there is a very fine line between tax avoidance and tax evasion. For the record, we are huge fans of tax avoidance, which is utilizing the Internal Revenue Code in conjunction with other advisory teams to make sure that a client is taking every legal deduction that they are entitled to without judge or jury. And what I mean by that last part is sometimes people will say, well, the ACA tax credits are a perfect example. When you get to the point of retirement, people will say, well, you're worth multiples, three, four, $5 million, and yet you or we as advisors and the client can get surgical with their income in such a way that allows them to qualify for ACA tax credits to subsidize the cost of health insurance after they're done working, but before Medicare kicks in. Now, somebody might say, why on earth would you help somebody do that when they're worth many, many millions of dollars? Couldn't they just pay for it on their own? Yeah, they probably could, but that's not our job. Our job is to utilize the tax code and utilize the regulations written in such a way that if they qualify and if we color inside the lines, great, take it. It's there for your use. Because if we start unpacking it that way, we could say, well, where do you draw the line on whether or not somebody should claim their mortgage interest deduction under Schedule A? If they can afford it, should they take it? So a little bit of a moral digression there, but my point with that is all of that falls squarely under the tax avoidance. The tax evasion in the extreme scenarios earns you an orange jumpsuit. Like that is illegal and you will go to jail in the worst case scenarios out of that, and or you will pay fines. Here are some examples of the former. I will give some examples of the tax avoidance. And one area that we can tell if the CPA is maybe a little bit more conservative, putting kids on payroll in the practice. If you have a legitimate, documented reason why your kids are in payroll, and they can be very, very basic. I mean, you're talking to somebody that grew up in a small business household. When I was the age of, so two daughters, ages 11 and 8, when I was 8, I was in the shop. My dad owned a cabinet making, my parents cabinet making and woodworking business. I was sweeping the shop floor. I was emptying the sawdust bins. I was cleaning up. Like, so clearly documented. You can pay your kids for that work performed in the business, issue them a W 2, pay them their tax rate. Essentially, you can shift income from your high tax bracket as an owner to your kids' tax bracket, which, as long as you keep their income under the standard deduction amount, essentially you're paying, they have zero federal tax owed. And now the wealth creation strategy there is use that to fund their Roth IRA. One of the lowest hanging generational wealth activities that an owner can do is putting their kids on payroll and using some or all of those proceeds to fund the kids' minor Roth IRA. Do any time value of money calculation and throw an extra 10 years on top of what was already a 35-year timeline, and you will see the power of compounding wealth. That's a low hanging fruit. If a CPA pushes back on that because they say, well, you can't do that, it's like, okay, tell me why. Where is that? Things like that, where, okay, if you can clearly substantiate the rationalization and follow the numbers as to why it is happening, and the CPA is still pushing back on that, it either tells me that A, the CPA just doesn't want to get, it's not even really being creative. It's just, I don't know why. That's one example. An example on the other end, the tax evasion side of things. And this is the part where I will probably not make many friends, ODs that are doing this right now, because it is usually one of the hot button topics that inevitably comes up sometimes in the online OD communities. Buying a car in the business when all you have is one single location and you're bonus depreciating 100% of that, and it's an over 6,000 pound gross weight vehicle like a Tesla Cybertruck or a G-Wagon or things like that. Because I have a hard time, I have yet to see an OD that can substantiate a 100% business use of their vehicle in the business, especially when all you have is a single location, because the mileage and use of the vehicle to commute from your primary residence to your primary location cannot be taken into consideration. So, all I can say with a little bit of honesty and a decent amount of snark is if you put yourself on the other side of the table from the IRS examiner, I would love to know how you would defend that deduction, that claim on the business tax return. The irony is, I get why they do it. They want the huge, like the sugar shot out of the deduction, like give me that big number right now. But then you got to deal with bonus depreciation if and when you sell the vehicle. It's like just take the standard deduction, just take the standard mileage deduction. The other really extreme example, and there was for listeners that might be interested, you can Google this. It's a court case that was judgment was, boy, it's been a couple of years, but there was a firm in Mississippi that had a relationship with an organization in the optometry space, and they marketed themselves, for lack of a better word, very heavily to ODs. And the concept was, you have an S corporation, Dr. Vargo, and what we're going to do is we're going to set up this C corporation. And this C corporation is only going to employ you, your wife, and any other immediate family. And we're going to take revenue from your S corporation, from your practice, and we're going to run it through the C corporation. And we're going to document all of the personal expenses that you have in that business as a marketing expense. And therefore, it's a way to shift money from the S corp. I'm being very abbreviated with this tax scheme, but basically we're shifting money from the S corporation into a standalone C corporation, sheltered from all the other team members in your S corporation, and I'm using that money in my quote unquote marketing shell company as a way to fund my retirement plans, pay for personal expenses to the business. That was this tax strategy, and they were shut down. And part of the injunction, by the way, if anybody did this, just as an FYI, not that I want to give you one more thing to keep looking over your shoulder. Part of the injunction that they received from the U.S. tax courts was not only did their entire business get shut down, but they had to turn over their entire client base and social security numbers of everybody that they recommended and implemented this strategy for within 90 days of the injunction. And so this company got shut down and they're forbidden from doing business in this space. And everybody that they did that scheme for is in the hands of the U.S. tax court system. Now, what the U.S. tax courts chooses to do with it, if anything, again, who knows? But that is an example of, as much as I hate to say it because it's specifically generic, if it sounds too good to be true, it probably is. If it sounds really complex, and if it sounds like if one of the value propositions of said strategy is, well, we will be here for your audit defense. Look, again, kind of back to that whole judge and jury thing. I don't know that it's my job to do that. That's not something that I want hanging over my shoulder. I would much rather focus my time, talents, and energy on ways of increasing the value that I can deliver in the marketplace and thus increasing my income rather than getting so consumed and spending so much time and energy on ways to mitigate taxes. I'll save on taxes the best with them all, or like I don't know if I'm saying that correctly, but I'll do everything that I can, but I don't know that I want to flirt on the other side of that fence. Does that make sense? That was a long monologue,
Absolutely.
Steve. I'm sorry.
No, no, it does. I'm hearing a few themes. I think some aggressiveness is good, but at the same time, working within the tax code and erring on the side of caution. I get what you're saying. Maximize value, maximize income. Don't get so consumed with the, you know, tax deductions that you're willing to compromise. Man, I think we scared a few doctors here today. I
I
mean, we
know it's
talked
like,
about, look at this. We talked
gosh,
about business getting shut down. You threw the term orange jumpsuit out there, and that's a first on this podcast. You know, you people are like, man, usually that podcast is pretty upbeat, but today you guys got real. But it's important. I think it's important. And when I read that post that you put on LinkedIn, it really got me thinking. Exactly. And I'm glad we had this talk because a lot of doctors thinking, I've got a CPA. I mean, they have to know what they're doing. I'll just sign this. But I love the term second set of eyes. That's what you guys do with your company. And I want to end there. I'm going to give you the last word, but I hope people realize how important it is that if you have access to that, use it.
yeah. And look, I appreciate you bringing that up, and I think you've said it a couple of times. I want to be maybe this is against better judgment from a business standpoint, but the only way that we do that is for our existing client relationships. We don't have a second service out there that is like a, hey, you need a second opinion on your tax return? Here, click here, upload here, and have like that is a value add that we provide as part of our ongoing service to our existing planning and wealth management clients. It's not a standalone service. Where I would go with that then is it demonstrates the value in having a complete professional team. If you're not working with an advisor that asks for your tax return, when I say advisor, financial advisor, CFP, wealth advisor, wealth planner, like whatever title they have on their business card or as part of their service to you, if they're not asking for your tax return and bringing your tax planning into their financial planning strategies, it's an incomplete plan. And I'll stand by that because you're going to pay the IRS more than any other organization in the duration of your working and retirement life. Why would you not, like, out of all the other things that you would pay for? I don't know if I'm making that point correctly, but the two certainties in life, right? Death and taxes. So why would you not take one of those certainties into consideration with the planning that you do? And one of those value adds should be the second set of eyes and review of your existing personal and business returns. And if you're a true DIYer from a financial planning perspective, I would just humbly submit to you that this is one more thing that you need to add to your list as your own financial planner, as your own second set of eyes. And so I would again just humbly submit, then that's on you to own and make sure that collectively you and your CPA are making sure that the right I's are dotted and right T's crossed.
Yeah, and I didn't mean to imply that that was your core business. You do that for your clients. I think I was a little aloof when I said that. But so if someone wants to become a client, how do they find out more about you?
I would suggest they check out integratedpwm.com. You can learn all about our firm and what we do there. I would also highly suggest you check out the 2020 Money Business of Optometry podcast, as well as the new show that we just launched, the Optometry Success podcast. Both platforms, or I should say, both shows are available wherever you're listening to this podcast. I guarantee you we're on that platform as well. I would search, once you find that show, I would search the name Dr. Steve Vargo, because those are some of the best conversations that I've had on that show. I think you
We'll
would
end
agree.
there. We'll end. I would agree. I don't know. Am I not supposed to agree? I
Certainly
shouldn't
two of the
say
best
that.
voices
No.
that you would hear.
Yeah, two of the best voices. Yeah, we'll agree on that. Hey, buddy, thank you so much. Always fun. I'm gonna let you go. I know you got another podcast coming up, and I will see you. I'll actually see you tomorrow on your podcast, but I'll see you at Vision Expo next week too.
Sounds good, Dr. Vargo. I appreciate you, my friend. Thank you.
Thank you. Take care. Thanks everyone for listening. We'll see you next time.